Okay, good morning, everybody. Thanks very much for joining us today and for taking time out of your morning. I think we'll crack on now. We've got a few people still joining, but in the interest of everybody that's joined on time, we shall make a start. Market update from Chris Peel and John Leeper, as I just said, but for those of you that have just joined, if you have any questions, then please do use the chat function and I'll make sure that we have them answered throughout the call. I'll stop rambling, pass you over to Chris. Thanks very much.
All right, good morning, everyone. Thank you for joining, taking time out of your day. We've got, the presentation really in two parts. To begin with, we'll do a market update, go through, what the team is thinking and any changes to the positioning. And then the second half, we spent an awful lot of time over the last couple of weeks expanding on, the blend of Acumen portfolios as a pre-retirement investment proposition, and we've done an awful lot of work with BlackRock in the last couple of weeks, as well as Morgan Stanley. So hopefully you'll find that analysis interesting. Just before we begin, I'd just like to apologize to anyone that we may have offended in the previous calls by making reference to you guys. John and I, we may be using that term in the plurality. We do not think that there's only males on the call. So if we've used it before and people have been offended by it, we apologize. Nothing is further from our thoughts in terms of, we're just talking to an audience, and we made reference to you guys as a bunch of people as opposed to a bunch of men. So we apologize. And if we use it again, that's the context in which we were using that phrase. In terms of, as we start the markets, again, this will follow the same routine that we've tended to use. John and I will go through them individually and alternate. But what's interesting is in the last couple of weeks, not a lot has really changed in terms of our positioning, mainly because the equity markets are basically where we were 2 weeks ago, and we're thinking in the case of the fundamentals, as we all know, are shockingly poor, meaning the global shutdown, certainly in the Western world, Europe and the US, is very severe, and the recovery time, it's a guesstimate only, but I think it's going to take many, many years to recover. That is not to say that equities can't continue to trend higher, but there's an awful lot of bad data points to come over the next 6 months. And the chances of a V-shaped recovery, it seems to have worked in Asia because they were better or more nimble in approaching the containment of the virus. The European response on balance has been very poor. It's been slow, it's been haphazard, and it doesn't appear to me, they just seem to crash the economy, and to start it back up again is going to take a long time. North America is probably better positioned for a V-shaped recovery because they've thrown more at it in terms of fiscal stimulus and monetary rate reductions. Rates were already low in Europe and in the UK, so it's had limited impact. So in terms of what we've done over the last couple of weeks is not a lot. We're sitting back watching to see if we can trade through these key technical levels. This screen is the MSCI World, which is our core equity benchmark. And you can see we're hovering just below the 100-day moving average. Not that the technicals drive everything, but this, and when you look at the next slide, I'll let John hop in here, but we're at key retracement levels. The fundamentals are poor. That's how we trade most of our risk the majority of the time. But the technical positioning now is it's going to take some very good news, maybe with the creation of a vaccine or better reopening numbers. But I don't see the reopening of the economy really seeping into equity market valuations until the fourth quarter. John, do you have any comments on this?
Just to reiterate what you're saying about, you need to be cautious with technicals, and by no means are they the be all and end all. However, they do provide a pretty good guide as to investor psychology and what investors are thinking. And you can kind of see the recovery here starts off very vigorously and then kind of like starts to tail over as investors think, well, there is upside, but it's less of a there's less of a case for it than there was before. And this seems to have brought us to a point where the indices are more or less in line with their 200-day moving average for the S&P 500. So if we were to see price action break above this level, it could indicate a longer uptrend, a breakthrough. However, the fundamental case remains that we've been through an awful lot. We've been in shutdown. There's going to be a huge hit to global economies, and yet we're not that far off all-time highs. So we've been taking a bit of a sit back, taking a bit of a backseat, seeing how it plays out really, and kind of letting that kind of feed through into our thought process and what we do next. The last thing I will say is, since our last call 2 weeks ago, there has been this kind of sense of optimism, this kind of we may be going back to work. Countries and states and counties are kind of reopening. We're seeing news of schools maybe reopening, and more shops are opening for business, albeit with 1 or 2 people in at one time. So we are going through this short-term bout of optimism. It's just a case of whether or not that optimism is truly justified, or whether in actual fact people are a little too enthusiastic, and we could see things fall back down again.
Yeah, and also just on that anecdotally, I mean, I move between Portugal and London. I've been based in Portugal for the last 2.5 months, working remotely, and we're further along the process than in the UK. Shops started to reopen 3 weeks ago. Bars started to reopen, but I would say that they're operating at 1/10 of capacity. It's a small fraction. Airports are still shut. Trains are still running at 1/5 of the timetable. So there's no quick return to what it was 3 months ago, given the evidence that I see here on the ground. And I'm sure the UK will be very similar. I think the US is different because, there's a lot of rural, most of the US is very rural. So the footfall is relatively small in 90% of the states. So I would expect the US to bounce back quicker. Sticking with the technical themes, what this is showing is, even though there's been a big bounce back, it's being driven by the big 5 or 6 stocks. Is what this is saying, that you're looking at the market cap weighted indices, which obviously have the Microsofts, all the FANG stocks, Facebook, Alphabet, Google, Netflix, etc. Those the big stocks that were driving performance over the last 2 years. It just so happens is that they're the ones that, as the world is working remotely, their revenues are going up. However, it's not a broad-based recovery, which shows if you look at the market cap weighted indices, S&P or MSCI World, versus equally weighted, what this is showing is that the majority of stocks are still in bear market territory. The overwhelming majority are still in bear market territory, and the bounce back is being driven by very few of the large cap stocks themselves. So one shouldn't, you look at the performance in some of these indices. If it's a market cap weighted indice, what it's indicating is that the bigger stocks are doing really well, and that the smaller ones, outside of the bottom 90% within the index itself, really are, they are off about 50% from the highs. So this has not been a broad-based bounce off the bottom on the 23rd of March. It's been a very, it's in 10 companies effectively that have bounced back. So when we're looking at our exposure, I mean, we've been long global technology with a skew toward the US, and we'll talk about another one. We've made an investment in a China equivalent. Those are the 2 sectors globally that have really done well during the first quarter. So, and that's where we're overweight, which is good. But the broader based indices are still indicating that the economy is going to suffer for a prolonged period of time. This is what this shows. John, you want to take a look at this one, small caps?
Yeah, sure. So this and the following three slides are looking under the bonnet. They're looking within the broad index, as Chris was just saying, to provide a bit more colour. So this chart shows the Russell 2000, which is effectively small cap stocks in the US, in blue, and the S&P 500, so the large cap stocks, in pink. Now, both of these have something in common, which is that they're saying stocks are expensive. So the large cap stocks have outperformed small cap stocks, and that's where we're allocated, and that's what that explains the price action in the prior chart. And you can see that because the pink line is the highest it's been in around 20 years, and this specifically shows the multiple on earnings that investors are willing to pay for a stock. Now, what's interesting is it's the same narrative for the blue line, small cap stocks, but it's the highest it's ever been. It's truly astonishing. The Russell 2000 is now valued at almost 70 times earnings for this year. So it's the most expensive it's ever been. It's completely nuts. The interesting question is whether or not you believe the earnings. So people are, some investors are willing to pay 70 times earnings. Do you believe those earnings numbers? Small cap stocks are very vulnerable. There's a chance that they will severely underperform given how expensive they are. And we have removed our exposure to small cap US equities to a large extent in the portfolios. This one is another way of looking under the bonnet. It shows defensive stocks versus cyclical stocks in America. When the white line goes up, it means that defensives are outperforming or beating cyclicals. So think of, when I say defensives, think of utilities, think of more conservative stocks. In fact, every time the white line goes up, you can see it goes up in 2008. That's during the subprime mortgage crisis. They outperformed cyclicals. And you see the same thing happening around 2015, which is the run up to the slowdown in economic growth around that time. And you see that spike right on the right-hand side. That's the same thing. What's interesting is the spike has come all the way back down again, meaning that cyclicals, by which I mean energy, materials, tech stocks, those companies that are highly leveraged to the economic cycle, they have led the rebound. But we're almost back to where we were before. The question is where it goes next. And if we see things improve noticeably, then this could extend further, and we could see cyclical stocks doing well. But the longer term trend, and they're shown by the hoops along the bottom, suggest in actual fact that over the longer term, it might well be defensive stocks that continue to do well. So this is something we monitor and we watch, and it feeds into how we're allocated in the portfolios. And then this one is my favorite of the three. The white line looks exclusively at the S&P 500 tech and consumer discretionary sectors. Sorry, the blue line. The blue line shows tech and consumer discretionary sectors. It's fallen and it's rebounded quite aggressively. That's that V-shaped recovery. That is determining the vast majority of the S&P 500 performance, because the big companies are predominantly in the tech sector, the FANGs, Facebook, Amazon, Netflix, Google, etc., etc. That's driving the returns. But look under the bonnet. Look at every other sector within the S&P 500. It's not going up. It's plateauing, and that's something that we're concerned about. And that is kind of driving our caution and our let's sit back and see what happens mentality at this stage. If the white line were to rise, that would give us more confidence that the recovery is kicking in. But at the moment, we don't have that confidence. And this is the COVID trade. So I don't know about you, but the fact that Uber Eats or Deliveroo is operating, we don't use it all the time, but it's quite nice to perhaps have a treat once a week, given how much housework seems to be involved at the moment because we're housebound. Food retailing stocks, particularly those that deliver, have done relatively well, but they've done well specifically relative to hotels and cruise liners, which have been particularly hit by the coronavirus. So what we've seen is food retailers outperforming hotels and cruise liners as lockdown comes into force and as the coronavirus starts to pick up. It's then kind of wiggled around a little bit. It's fallen and risen. It's effectively gone sideways. That's interesting because if there was confidence within the market from investors that we're coming through the coronavirus and that the economic recovery is going to pick up, then one would expect the white line to fall back down again. But that's not what we're seeing. We're seeing continued caution and risk aversion at current levels.
Yeah, and so basically the theme of the last 4 or 5 slides is, you know, we this is a time to be cautious, to be plowing into the market, buying on these forward price earning multiples ahead if one believes that this is going to be anything other than the sharpest V-shaped recovery on record. You know, it's a very risky trade, and so this is why we're invested. We've got a cash position anywhere between 7 and 10% in the portfolios, and we've got a bias toward quality stocks, companies that generate a lot of cash, have a lot of cash on the balance sheet, and low levels of debt. Those are the types of companies that, as we go through the summer months where the data is going to continue to be shocking, I think will be the safe haven trade for long-term investors looking to ride out the storm, which is why we're positioned where we are. This is just the trade I alluded to before. We like technology, and we've been long the S&P or the US-based large technology stocks for quite some time now, you know, the thick end of 2 years, and it's been a very consistent trade that has outperformed our benchmark. We've been looking at China, you know, China being the second biggest economy in the world. You know, they do have equivalent companies to Amazon. In the case of Alibaba, looking down on the right, Alibaba, look at the earnings growth expectations, very compared to Amazon. They're even greater. Tencent, similar to Facebook, Baodo, similar to Google. We've entered into a trade based on the Chinese economy domestically, coming out of the coronavirus shutdown at a faster pace than the Western equivalent, and you know, the propensity, the average 25% of retail spending in China is done on the internet, compared to I think around it's like 12 or 13% in Western Europe. So by as a nation, those that have the internet, which is about 60% of the population, vis-a-vis 90% in the Western world, they tend to shop online anyway. And we've started to already see the sales numbers, especially in the higher end, the Nikkei, the Adidas, the LVMH. The Chinese consumer is coming back. The factories are now operating at 85% capacity from the end of the year. So the China roadmap is still how we're positioned, but I think I can see a V-shaped recovery in China, to a certain degree in the US, but certainly not in Europe. The European economy was in poor shape before the lockdown. It's in a worse shape now. And so we're seeing our global equity exposure is barbelled between Asia, South Korea, China, Taiwan, and North America. Both those economies are better positioned to reopen at a faster pace than Europe, and especially the technology sector. So this is a trade we put on. We will probably add to it. Again, we're buying the China only equivalent. Most of these companies are listed not in China, but either in Hong Kong or the US. And just so there's no confusion, when you're looking at, we're not long the Hang Seng, we're long larger companies within the Hang Seng index. The current political turmoil in Hong Kong has brought a lot more volatility to the Hang Seng index, so the Hong Kong-based stock market. But we're long only a sliver of that indice. So you might come in and see the Hang Seng down 5% because of the riots. It's not directly impacting an Alibaba or Tencent because they're doing business. You know, their shares are listed in New York, and they're doing they're doing business in China domestically. So this is part of our technology trade. We've been trying to get bigger exposure to China, because China is a big part of our benchmark, but we've been unable to up until this date because there wasn't sufficient liquidity in an ETF that we could buy. So this is at the moment a half a satellite position, which we will build up to a full position, I'm sure, by the time we speak in 2 weeks' time. You want to do these next couple of slides, John?
Yeah, so that was the end of the equity section. These next few slides look at whether the narrative we described plays out across other asset classes or other indicators. So this particular slide looks at the Baltic Dry Exchange Index. So it looks at shipping. It's a useful long-term indicator, slightly volatile, but a useful long-term indicator for confidence in global trade. As you can see, it's kind of avoided the lows in 2016, which happened when China devalued its currency. But it's still very low historically speaking. Now, if we had seen general relief and an expectation that the recovery would pick up steam, one would expect this index to pick up. It's not, and that feeds into our sit back and apply some caution at this stage philosophy. Same thing applies to industrial metals. Industrial metals are used in the production chain. What we're seeing is it's picked up slightly from the recent lows, but not much. If we were to see full confidence in the economic recovery, we would expect industrial metals to pick up steam. Because we're not seeing that at the moment, it's kind of staying our hand. We have been considering a number of ways of playing partly a reflationary trade theme, partly the coronavirus, meaning that the supply of certain raw materials or metals used in the production chain, but the constraint in supply in terms of the coronavirus locking down the movement of goods could feed through to a pickup in these prices. But as of yet, we're not really seeing copper, for instance, really picking up relative to the benchmark. So we're still sitting on the sidelines and watching with interest those areas that might in the future be an attractive proposition for the portfolios.
Yeah, and just as a theme, as John said, we are looking to harden the portfolios, because we can see near term a period of deflation, but because central banks are printing money at record paces, they're devaluing the monetary base. You're doing the MPC in the UK, the ECB in Europe, same in the US Treasury in the States. They're buying bonds in the secondary market. It's the same thing as, as I said the other day on my market notes. A pound isn't going to be worth a pound in 5 years' time. A pound in buying power might be worth 90p because the government is printing money. It's it's economics 101. If a country gets into debt problems, what do? They inflate their way out. This will happen at a point in time, which, when you look at the last 4 recessions, you've seen commodities in particular lead the way out because, people eventually are looking to harden up their portfolios. So given how attractive commodity valuations are today, I'm not saying we go in today, but we're looking very closely at this space. The agricultural, the supply chains globally have been shattered because of the lack of movement. Farmers in the US are plowing under their fields because their demand at the restaurant level has gone to zero. It's easy to take a look at the loss of life because of the coronavirus, but you still have people in Africa that are starving because of the locust situation, where it's been unusually hot, so their food supply has been diminished, and yet you've got other parts of the world that have crops that are being plowed back under. It's madness in my view. But what it means is it puts upward pressure on commodity prices because there's a shortage. And in reality, there shouldn't be a shortage, but there is. You look at the price of hogs, cattle, soybeans, corn. The prices are trending higher because the supply chains aren't working and the crops are being left to rot or being plowed under. So again, we're looking at this space because we know in the last 4 recessions, commodities and equities have tended to rally over 20% 2 years from the middle of the recession period. So it's a question of when that middle point is. But we are looking at this space, and we haven't done anything yet, but it does not mean that we won't. John, do you want to take this slide?
Yes, this is the last one in this section. Essentially, it points to what's happening in the mortgage space, in this instance in the US, because the Fed has really stepped on the pedal, provided a lot of liquidity to the market, but perversely, it's had an effect. It's had a perverse effect in the mortgage market, in that it's actually led to mortgage rates going up relative to the underlying benchmark, so the US government 30-year yield. I don't think that was the intended consequence. It's a nuance within the rather idiosyncratic mortgage market, but it's interesting because if you have mortgages becoming more expensive, that's not necessarily a positive thing for the broader economy. So to kind of summarize, the S&P 500 has bounced back a lot. It's running into resistance levels. However, under the bonnet, it's only really the tech space that's driving those returns and large cap. Plenty of other sectors are struggling. And what we're seeing is across other markets, such as mortgages, this slide, the commodity space, etc., we're not seeing the same story play out. And the longer that continues, the more likely you'll see equities kind of come back in line with what we're seeing elsewhere.
All right, thank you. This is some bond spreads. You know what this is showing is the average spread of in white. That's our benchmark, our developed market benchmark, the Bloomberg Barclay Global Aggregate. What that is saying is that spreads are still wider than they were entering March. We had a sell-off, but we've had a bit of a recovery. And global high yield in blue, which is we've got that's also part of our benchmark. You can see spreads widened quite markedly in March, and we probably retraced half of that underperformance. So spreads widening mean prices falling. We remain underweight the high yield part of our benchmark. The reason is, there are companies we've already seen: Hertz, Latin Airways, J.C. Penney. There are companies hitting the wall, and we expect. I think John wrote, last week, we expect the bankruptcy rate globally to push toward the 20% level during this recession, which means the weaker credit-worthy companies are going to suffer to reinvest or roll over their amount of debt, and also liquidity is poor because the Federal Reserve in the U.S. is buying a part, the triple B sector, the double B sector of the high yield market, but only those that were downgraded. That's not going to make those companies any more creditworthy, and it's not going to prevent them going into default. They have no revenues. I would expect hotel chains en masse to go into bankruptcy. The Hiltons, the Marriotts, the Wyndhams, they can't afford to lose 3 months of revenue. So I would expect, much more high yield debt to default, and these spreads to remain elevated for the foreseeable future. And that's consistent with market consensus forecast. So we're underweight high yield. We continue to believe that's the right trade because companies with zero cash flow will go out of business. John, do you want to take the UK one? This is a very interesting slide.
Well, I know this is your favorite slide, so I'm happy if you want to run with this one because you love this slide.
Well, this slide it just shows you this is 50 shades of madness. Okay, the blue line is the 10-year gilt yield, which is down at 23 basis points. You can see
Yeah, it says my speaker's muted. I can't hear what they're saying.
Anyway, so let's continue. The 10-year gilt is yielding 23 basis points. The white line is the public sector net borrowing requirement in the UK. It's forecasted this year to go to 60 billion, which is on the right-hand side. But that was the number of 60. I think 61 billion was the amount of borrowing requirement as of maybe the end of February. That now, on the left-hand scale, you can see there's another white line. It's now expected to go to 280 billion this year. When you say it's off the chart, it is off the chart. So why anyone wants to be long UK government bonds when the public sector borrowing requirement is going from, typically it's around 25 billion. It was forecast to go to 65 billion. And now it's going to almost 300 billion. So if one believes, well, it's okay, the central bank's just going to buy bonds forever, that's fine. But they're printing money and just throwing it out in the street at 80p on the pound. This slide is a problem, which now is going to lead us into the next section. This is the most important slide in the deck. The bond markets are broken. Investors who would typically be buying investing in bonds, whether it be corporate bonds or government bonds, even high yield bonds, are going to get negative returns for the next 15, 20 years, which means we all need to think differently on how we invest towards retirement. Which is where we go into this slide. This is the slide that we had in the deck from 2 weeks ago. It's how, I've taken the construction workers pension scheme and we looked at blending as you get closer to the retirement date, a risk asset, so a multi-asset portfolio comprised of bonds and equities, consistent with an A2R, dynamic planner, whatever you're using, and a monetary asset, which would typically be a bond of some description, a high grade, investment grade bond, maturity 10 years. Sort of a cash good investment is what you would normally be blending with, and cash. Now, the monetary asset bit no longer works. Every actuary in the country was saying, well, you're going to buy bonds. You're locking in a loss. And we've done a lot of work. Well, internally, over the last 2 weeks, we've spent many, many hours of trying to model the return on assets on a forward-looking basis. This is really important because if you look at bond returns over the last 20 years on an annualized basis, you'll get numbers of around 5 or 6%. Well, if we look, I'm just going to very quickly hop to the bottom. We've taken these from BlackRock. These are BlackRock capital market assumptions. They come out of the BlackRock Institute, which is their think tank. They meet quarterly, and it's 30 individuals with 25 years experience at a minimum. They sit around a table and they talk about markets, and they come out with, well, what do we think on a rolling 5, 10, 15, 20, 25, 30 year basis? Do we think, where are we going to, what are the expected rate of returns? Over the next 5 years, look at the yellow dots. The yellow dots are UK government bonds, index-linked bonds, long-dated UK corporate bonds. These are below the zero barrier, compounding at a negative return. So if you buy UK government bonds for the next 5 years, you're compounding at a negative, little over 2% per annum for the next 5 years. So that doesn't work as a retirement solution because you're locking in a guaranteed loss. So what we've done, and I'll let John hop in here, but what we've done is we've taken going back to the front page, what we've done is we've mapped this roadmap where if you're up to the age of 40, 90% of your investment portfolio will be invested as normal in a risk profile 3 through 8 on dynamic planner, and this pension scheme recommends a 10% allocation to a monetary asset, a bond-like investment. And as one goes closer to retirement, you can see that it moves into from a monetary asset for under the age of 55 to which in this case we've defined as the Acumen Income Protection Portfolio, and then it maps across into the 90% protected, either the Acumen Capital Protection Portfolio or the Acumen ESG Protection Portfolio. So what it's doing is we're taking bond market-like risk, but in a liquid fund structure that has a greater allocation to equities than otherwise would. That's really important, obviously, in the guarantees coming from Morgan Stanley. It allows you to, and also going back to time, when Brian asked me, think of a product, we've got issues with the level of the bond markets, what can we build as a bond proxy? The protection portfolios that we have created were designed as an alternative to bonds. They are not designed as an alternative to equity markets. The equity markets, as we've shown in these talks before, we still think very strongly that we're in a 70-year bull market. That channel has not broken since the end of the war. We see no reason why it's going to break now. The bottom of the trend line was tested. So if on a long-term basis, your investors should remain long equities, but as you get closer to retirement, you need to think of a new way to play the bond space. And it's not a good idea to double down on equity exposure getting closer to retirement, as we know, because if you retired in April, well, depending on your valuation, you lost 20% of your pension pot. So you would have been better off having moved more of that into a bond and or cash surrogate. So what we've done is we've taken the BlackRock forecasts from the BlackRock Institute, and we blended along this time horizon, what the returns would be if you played the rebalances over the 25-year period. And what's interesting is, this is, if it's 25 years, this is a better screen. What it shows is we've got 5 red dots. Well, there's lots of dots. You can see the equity forecasted returns are higher volatility, but higher rate of return. If I were to draw a circle here, the average rate of return in the global equity markets is around 7%, but you've got risk at around 15%. Over the next 20 years, the average rate of return in bonds is going to be about 2%. But the red dots are the blend of the Acumen portfolios, risk profiles 3 through 8, the protection portfolios, the 85 and then the 90% protected, and also cash. We've taken the same allocations given by the trustees at the construction workers pension scheme. But what you can see here is that, and I'm sure everyone's aware that the protection portfolios are not always 100% invested. The average participation rate dating back to 2002, this is where we did this work with Morgan Stanley, is 90%. So we've taken the benchmark, returns, or the benchmark holdings for the Acumen portfolios. In this case, it's Acumen Portfolio 5, Risk Profile 5, the split between equities and bonds, and the same thing in the protection portfolios, and assumed a 90% participation rate, a 75% participation rate, and then 50. And you can see that the red dots, that the 90% has the highest return, slightly more risk, and then it moves slowly to the left. What's interesting is if the Fund B global bonds, that's if you instead of using the protection portfolios, you invested, the monetary asset in global bonds. So that is the far left. So it's less volatility, but significantly lower rate of return on an annual basis. But Fund B is if you bought UK bonds. If you see Fund B UK bonds, it's the lowest return of the red dots over a 20-year period. So we are taking forward-looking equity and bond forecasts and then re-engineering those returns on a forward basis, and then blending the allocations between a full-fat Acumen portfolio 3 through 8 and one of the protection portfolios. So what you're able to see here is we get a higher rate of return for a lower amount of risk when compared to traditionally buying UK bonds as you go into retirement. And this sequence, what you can see here is an example. This is a 20-year slide. If you start year 1 at 100,000, 20 years later, if you're in the Acumen 90% blend, not 90% participated portfolio, I forget which fund it is, 240,000. But if you look to the right, you can see the returns get lower. UK bonds, 208,000, 214,000. It's only UK equities that have a higher rate of, global equities have a higher rate of return. So the Acumen blend examples using the protection portfolios, aside from being fully invested in equities in perpetuity, which obviously a trustee would never want that to be the case, it allows you to get the next highest level of return compared to global bonds, global equities, UK bonds, etc. This is quite telling, especially if you look at, I'm going to flip forward to the 10-year example. If you're 10 years out from retirement, you put 100,000 in, you have 139,000 in the Acumen 90. But if you've blended it with government bonds, you've lost money. You've got 88,000, 628,000 bonds of your original 100,000 on a 10-year forward basis. Keep in mind, you've had money in risk profile 5 and it's been blended with the protection portfolios. This is where it's really important. I can't do this for you, meaning I don't know your clients. I don't know how old they are. I don't know when they're going to retire. But you I said you guys, I apologize. You all, you can see that you're going to be better off blending with one of the protection portfolios than you are traditionally moving into cash as you get closer. And this is even more pronounced. Look at the 5-year numbers. The 5-year bond forecast coming from BlackRock. The UK numbers are all below the zero line. You cannot afford to be putting your clients into government bonds or even corporate bonds. You know, you're locking in a guaranteed loss into retirement, and the numbers here are stark. Again, over a 5-year period, 100,000 into Fund H, equates to a UK government bond total return of 88,000. So, this is the dilemma. These were built as a proxy for the bond market, and given that bond yields are basically negative now, all of a sudden the protection portfolios, assuming even the participation rate, the average was 90 on a back-tested basis. I don't see any reason why it won't continue to be 90. Volatility is starting to come down. We have the ability when we have the ability to increase the participation rate, but only when we think it's safe. But more importantly, when we think markets are going to go up. We're now at a technical level. The fundamentals are rubbish. Technically, we think we're running into severe, big upside resistance. There will come a point where, if we correct down, we can move the participation rate into the 50 to 60% level. As long as volatility stays low, it'll accrue back to 100. So I think the average participation rate at 90%, which is what it showed from 2002 to up until the end of February, that's a realistic number to shoot for. And you can see that all these pages, obviously it's driven by how many years to retirement an individual has. You're always better off having been blended with a protection portfolio based on these percentages. John, do you want to hop in here?
I think you've done an excellent job covering the whole topic, and the key is, I don't know how as a company we would go about implementing this. As you said, Chris, it requires the advisors who have the knowledge of the underlying clients and their age and their specific needs and requirements, and to ensure that the proposition is both suitable and appropriate. But I think that there's a clear case to look into implementing something at a company level that really gets the most out of the protection portfolios. And I think this solution that we as an investment team have put together, I think this goes a long way, maybe not all the way, but this goes a long way to kind of demonstrating that capability. I mean, one question I noticed has come up on the chat from Mark. He said, do you see the same problem in the US bond market, or is that likely to be either less negative or more positive by a significant margin. I mean, imagine, Chris, you have a view on that. I would just answer that for the purpose of this exercise, we felt the message would be most clear if we remove any kind of subjective opinion from ourselves, and we're always more than willing to give you our opinion on what we think about the markets, and just focus on the capital market assumptions provided by BlackRock. And therefore, to answer that question, you can refer to each of the slides, 25 through 5 years, and look at the yellow dots and just compare the global government bond dot to the UK government bond dot, and across all those timescales, in the majority of instances, the global return is higher and less volatile than the UK equivalent. I can't really expand too much more on that question, because actually it's a very complicated question, seeing as FX hedging costs are pretty much close to zero, and that could suggest that more funds may well flow into the US and into US bonds, and the fact that the Fed is now talking about yield curve control, that will have an effect on it. In other words, it's a much bigger question that maybe we can come back to and address another time.
But this slide, going back, sorry, John, but this slide here, it's the white line seems like it's a misprint. The UK is going to borrow just shy of 300 billion pounds. Okay, and you look at the white lines going back through time. They're tiny. It was already large at 60 billion. Now it's going to 280 odd billion. It's a huge number, and it's coinciding with the yield being effectively at zero. This is the 10-year gilt. This is catastrophic for medium to long-term bondholders. You're locking in. Forget about inflation. I mean, I think inflation is going to be benign for the next 12 to 18 months, and then it's going to come back with a vengeance, because no one's buying these bonds. It's the central bank that's buying them. So they're printing money. So they're debasing the currency. You will not, your spending power, today, if you have £100, you won't be able to spend £100. You'll be able to spend 75. The white line is catastrophic, and the government hasn't thought this spending through properly, because that breeds inflation with a vengeance. Going back hundreds of years, the government is printing money and throwing it out the windows. It's not worth. It's what the emerging markets were always accused of, printing money. The UK is doing it on a epic scale. So, which means this whole ride to retirement, when you get into the 55 to 64, the last 10 years, the purple is the monetary asset. You can see it goes from 30 all the way to 67. If you're following a trustee's recommendation, you are losing money hand over fist, because they have you going down an alleyway into a certain financial loss on a nominal basis, but also on an inflation adjusted basis is even greater. So over the years, Tavistock Wealth, collectively, we built an investment proposition that's comprised of 10 UCITS funds. I think it's one of the most comprehensive, wide-sweeping offerings in the market. Okay, they're all multi-asset, other than AP8, which is 100% equities. You've got low risk to high risk, and also now you've got bond proxies, the capital protection portfolio, the ESG protection portfolio, and the income protection portfolio. As a company, I go as far to say we have one of the best offerings anywhere in the world, because it ticks all the boxes, especially in the current environment. So the takeaway is stare at all these charts, and look at the red dots, and look what is in the typical portfolio, which there's a lot of the yellow dots. You're going to be losing money, and these numbers again just show 100,000 today. 25 years later, it's 317,000 quid. assuming the markets grow in line with the forecasted returns, and we perform in line with our benchmarks, which is what we've done, over the long term. This is a big takeaway, because you can see the red line is below the white line, but it's also a lot higher than the yellow and the blue and the purple lines. And if this is repeated throughout the glide to retirement. And we've worked very closely with the retirement solutions desk at Morgan Stanley, who we work together with on the protection portfolio. And the forward-looking returns are coming from BlackRock, the largest fund management company in the world. We've got good partners here. This is something that is relevant, I think, for every client in the UK, because every client in the UK will typically, close to retirement, have a bond allocation that for now is guaranteed to lose money. And when you add inflation on top, the losses on purchasing power basis could be as high as 20% on the bond allocation 10 years from retirement. So, there's a lot of numbers supporting these charts, but like I say, the investment team, we work very, very hard to be impartial, to be fair, and represented in a way that, you want to be on one of the red dots for sure. And, if we just take the average participation rate at 90, that would be your expected annualized rate of return, in this case, over per annum for 15 years. And it makes a big difference, as I say, when you look at what does it actually mean at the end of the day. What's the pension pot grown to? And obviously, the more years you have to go, the greater the pot size. But the 5-year numbers are quite telling. Virtually all the UK fixed income lines, dots, are below the zero barrier level on a compounded basis. So it's a no-go area. Has to be a no-go area from a retiree's perspective. And you can see the red dots are above the line, and this is where the majority of the assets are either in the 9% guaranteed funds with 10% downside maximum, and it's a much better solution given the level of interest rates and the debasing of whether it be the pound, the dollar, or the euro, or the yen. They can't keep printing money in perpetuity without the bond markets, falling over horrifically. And and BlackRock will be conservative because that's the nature, because they don't want everyone to sell bonds. But you can't fight with the fact that they're forecasting negative compounded rates of return in all UK fixed income securities for the next 5 years. And if you go back to even the 10 years, the 10-year numbers, again, are negative as well. So, I think Ben and Steve will be doing some follow-up on this. But this is, I feel very strongly that this is the way to position the protection portfolios in the context of a wider investment proposition. They fit very, very well from a risk control basis as a proxy to bonds. Bonds are overvalued. They're not worth 100 cents on the dollar in terms of purchasing power. If you don't take it from me, you can take it from BlackRock. So there's an awful lot of seasoned professionals that have gone into creating this, and I think advisors inside the group, outside the group, this is the message that needs to be told, because you've got to get out of the way of the bond market, because you're locking in a loss for your client. That's my strong belief. I wouldn't take money out of. You don't want to take money off the table in equities if you're 40 years old, but if you're 10 years from retirement, you probably should be doing a migration. But you don't buy bonds. You buy something that's equity-like in terms of risk, but with downside protection, no worse than bonds. So that's the message from me on this. We've done a lot of work, let's say, with BlackRock and Morgan Stanley. I think the output is pretty conclusive. what is certainly viable or investment solution for many clients in the UK who are worried about losing money, in 10 years from retirement. You cannot, the rules are different. The correlation between bonds and equities is breaking down from the 40-year norm, where, if equities are rallying, bond prices are falling because the central banks are hiking interest rates to take some of the steam out of the economy. That relationship is clearly breaking down. We saw it in March when Treasury yields spiked, and so bond prices fell and equities fell. So they're correlating together now, which is very worrisome. So this is the takeaway. I don't really have anything more. This is a question, Steve?
No, had no more questions come through, Chris. I think you've given plenty of food for thought there. Certainly, as you said, we will be working with advisors on this because there's a real risk there in the traditional allocation and the lifestyling process, moving away from risk assets towards traditionally low risk assets, which, as you've just proven, are anything but at the moment. So we'll do some work on that. We haven't had any further questions come through, although something's just popped up on the chat from Andy. Given Chris's comments on bond markets, is the need to map the portfolios to distribution technology risk profiles, which are based largely on asset allocation, now seen as a hindrance to positioning the portfolios? Taking Chris's example and avoiding low duration government debt and replacing with protection portfolios, has anyone looked at how this impacts the overall risk assessment by DT that we as advisors must adhere to when placing client assets?
Well, we don't map to dynamic planner asset allocation. We map to dynamic planner volatility targets. It's the same thing, but it's also not exactly the same thing. But their risk curve is our risk curve. They're exactly the same. So when we have a benchmark of 60% bonds, 40% equities, we may have slightly different regional allocations around the world, but we have this where our vol is their vol. We're speaking the same language. The volatility of the bond market and the equity markets is what drives these on a historical basis. I don't see that necessarily, those relationships changing, but in terms of profitability, I think bond market volatility can remain around the historical norm, but you're going to have capital losses. You will have capital losses. I don't want to speak necessarily for dynamic planner. We're in a quarterly review period now, where at the end of each quarter we send all of the positions across all of the portfolios, including the protection portfolios, to them, and then they give us not a health check, but they review where we are relative to their volatility curve. And we'll get those results sometime in June. I've got no reason to think that we'll be out of kilter, although I would expect the risk profiles of the protection portfolios to be lower, because one could see how they performed in Q1, where they lost a lot less money than the unprotected version. And so therefore, on a risk curve, it's not rational for them to be the same risk weighting as they currently are. The Acumen Portfolio 4 and Acumen Capital Protection Portfolio are both risk profile 4. It's been our opinion, the investment team's opinion, that that's wrong. And they now have agreed that they were wrong, but until they put it in writing to me and change the risk ratings, it's premature for me to say that I was right and they were wrong. John and the team have done a lot of work with the Boffins at a dynamic planner. So what you'll see is you're going to get then this argument's even better, because you're actually, because the risk profiles of the protection portfolios will be closer to bonds. But we don't expect, by the way, to lift off the dynamic planner risk curve, because that's our job. Our job is to, and I also don't think volatility is in both markets. I think volatility in equities and bonds over the next 5 years will be a little bit higher than the preceding 5 years. But I think equity market returns will be positive and bond returns will be negative. Dynamic planner doesn't forecast returns. It's all based on volatility. So the volatility will stay within our volatility bands, but the returns, I mean, I think BlackRock is right. They've got it's not one or two people sitting around a table saying, well, let's guess. It's the BlackRock Institute, and it's 30 investment professionals with a minimum of 25 years experience each, sitting down on a quarterly basis, going asset class by asset class. What do we think? What's changed? It's the most comprehensive, it's a forward-looking forecast I've seen put out by anyone. Because quite often, if it's an investment bank, you know, it's one person thinking, oh, well, consensus forecast is this, let's just be closer to the herd. The BlackRock Institute, it's a separate company within BlackRock. Their forward-looking projections, I think, are the best consensus forecast at an asset class level I've seen anywhere. So the takeaway should be, look at the yellow dots and look at your client positioning. And then, I'm not a financial advisor. I don't know a client's certain priorities or investment views or retirement plans, but you collectively, you know that. So this is something I can't do, but the best way to get the most out of the Acumen portfolio range is to start blending as a retirement solution, because it'll keep your clients out of harm's way in bond land. You know, bonds can stay irrationally priced for a long period of time. And as John Maynard Keynes says, markets can remain irrational longer than one can remain solvent. So I'm not saying don't buy them. I'm saying you can have bond exposure without being in bonds. That's the trade-off. Buying something at 23 basis points, you're losing money in inflation at 1%.
Thank you, Chris. Before we come on to James's question, just whilst we're on the subject, still loosely on Dynamic Planner, have we any update on their rating of the Acumen ESG protection portfolio, please?
All of the ratings are with Dynamic Planner. ESG protection portfolio is a new fund, so that means they have to go through something called an initial risk profiling process. It's quite frustrating because I keep asking them for an update and they can't tell me when they're going to get back to us or not. But at the moment, they're doing the regular quarterly risk profiling, but they're also doing a more enhanced review of the protection portfolios, not just ESG, but the capital protection and income protection as well. It could take a while, but we're chasing them consistently because we need to understand if they're going to make changes to how they risk rate those portfolios, because that will have a consequence for the profiles and how they are allocated. And we need to make sure that the entire proposition is sitting in the correct risk bucket. So unfortunately, it's out of our hands. We're chasing them on a regular basis, and when we know, you'll know. Is the answer to that. And if you don't mind me just picking up on what Chris was saying, James's question, how will we manage bonds in the funds going forward, kind of relates to Andy's question. And stepping away from this life styling approach, I think both those questions are key to how we manage the Acumen funds. I don't know if everyone has had a chance to see, and perhaps Steve, I see you've posted a reference to a blog already on the chat. Maybe it would be worth reposting the link to the who, what, how, where, why document, which explains how we manage money. I think it's a really, really important point that the outlook for UK bonds is negative. Chris has made that case abundantly clear, and it's also the view of the investment professionals at BlackRock. So those investment firms that have the same allocation to UK bonds as prescribed by Dynamic Planner, they are going to suffer going forward. It's the case currently, and it has been the case for quite a while, that the investment team at Tavistock Wealth do not put 20% into UK bonds if dynamic planners say you should have 20% in 20% in UK bonds. We say we need to be in the right risk bucket. The volatility within the Acumen funds needs to match the volatility that dynamic planners ascribe to each risk category. But it's our decision as an investment team whether we want to have more or less in UK bonds or indeed any asset class. And we have significantly less exposure to the UK, not only in equities, but also in UK bonds. And that is a key selling point. That is a key differentiator. It separates us from the competition. And it's exactly why advisors need to be looking to the full Acumen range for their clients. So good question, and the answer really does play to our strengths.
Thanks, John. That's helpful. And I've just posted that link on there. You can find that also within the blog link. Unless there's anything else from anybody else, I'm conscious that we're a little over time. Thank you very much for all of your attendance. It is appreciated. And thanks to Chris and John. Really interesting. Lots of food for thought. Do come back to me if you've got any follow-up questions. I'll make sure they're answered. And in the meantime, we shall let you crack on with your day and get another invitation out for a couple of weeks' time. Thank you very much, everybody.